Hi, welcome to Takeaways. My name is Jordan Brooks, Senior Market Analyst for ALN Apartment Data. And in this month's newsletter, we kind of did a breakdown of third quarter multifamily performance, comparing to previous years, and then looking at the year as a whole, where we're at as an industry as we get into the final quarter of the year and round into finishing off 2024. The newsletter really went into some detail on broad strokes of what we've seen nationally in terms of continued improvement in apartment demand, but of course also very high levels of new supply and sort of how the interplay between those two have affected other performance metrics like occupancy and rent growth, as well as the continued resurgence in lease concessions as well to bring those really to a point above anything we saw during the pandemic era. But what we didn't spend much time on was a regional or market level look. And so today in the takeaways video, I wanted to spend a little bit of time there. And the first area of focus is some specific regions or markets that stood out in terms of the general performance metrics. So, apartment demand, rent growth, things like that. And I would say below the national numbers, we're really talking in terms of apartment demand about the Sun Belt. The Sun Belt continues to do very well in terms of net absorption. That gets obfuscated a little bit because of the generally lower average occupancy that's come from just the deluge of new units going back years at this point for that region. But looking at just net absorption itself, quite robust for the Sun Belt region. In particular, the primary Texas markets have seen a nice resurgence from the 2022 and early 2023 period. DFW is number one in the country for net absorption through September of 2024. Houston is number two in the country. Austin is also in the top 10 at number 6. So Texas well represented, as well as, again, the Sun Belt more broadly. When we look at net absorption on a size adjusted basis, so market level net absorption adjusted by the size of that market in terms of multifamily stock, the Mountain West really rounds into view there. So the Sun Belt still has some markets that populate the top of that list, but the Mountain West also has a number of markets near the top in the nation for size adjusted demand. And there we're talking about the state of Montana, Rapid City, South Dakota, Boise, and Salt Lake City in terms of a larger market in that region that's done well from a demand perspective. So all of those markets were in the top 10 nationally for year-to-date net absorption, again on a size adjusted basis. And then something else, obviously rent growth is always a major topic when we do these quarterly or annual reviews. Rent growth has been a little bit down generally this year, again, nationally. We've seen demand do really well, but that's kind of come at the expense of softer rent growth. Nevertheless, though, in terms of market leaders, there are some standouts. There's less regional skew in the rent numbers and more by market size. So if you look at the top 20 markets for average effective rent growth through September of this year, only 2 of those even have 1,000 conventional units. So the vast majority of these top performers for rent growth, we're talking about smaller markets. Those 2 relatively larger markets that do at least crack the top 20 would be Cleveland, Akron, and then Buffalo, Syracuse. So again, not exactly, huge gateway markets, but nevertheless, at least 1,000 properties, conventional properties. So some of that skew towards the small markets, of course, just has to do with the fact that they're small. So smaller markets are going to have higher variance in these percent change metrics just because the sample is smaller. Aside from that, though, if you look at the new supply load in these markets, it's relatively lower than we see sort of in terms of a national average, again, even when adjusted for size. So that means that average occupancy has been maintained at a higher level, broadly speaking, or at least that average occupancy has not had to face down the headwinds that come from a lot of new supply. So that obviously helps with rent growth. But what we can't say is that the top performers in rent growth are there because of especially robust demand. If you take the top 20 markets for rent growth this year as a group, they actually have below average demand, again, even once adjusted for size. So the rent growth dynamic really is more a function of less new supply pressure, less downward pressure than on average occupancy, and then those higher average occupancies allowing for more typical rent growth. And so again, on the topic of new supply, that continues to be a major factor for the industry. Obviously, the newsletter went into some detail on that, but there are some important differences in how the next year or two are expected to play out in terms of new supply, again, sort of below the aggregate national numbers. Some of the markets that have sort of been at the forefront of the new supply boom over the last few years are sort of at their peak or already now on the other side of their peak for this cycle, and should see deliveries over the next 2 years lower than they've seen in terms of new supply over the recent years. Markets that sort of fit into that basket would be Dallas-Fort Worth, Atlanta, Tampa, Nashville, Austin, Houston, Salt Lake City. And that's not an exhaustive list, but again, these are Sunbelt, Mountain West markets that have really been at the tip of the spear for new supply. These are markets where the daylight appearing sort of at the end of the tunnel here for this cycle of a historic construction boom that those markets have seen. And then another group of markets would be areas where upcoming deliveries are expected to outpace recent deliveries. Some of these markets have been very active already, and they're just not quite to their peak yet for this cycle. Other markets have not been at the forefront of new supply, but are going to be ramping up over the next couple of years. So markets in this kind of broad group would be a lot of the California markets. So LA, Orange County, Sacramento, the Bay Area, the Inland Empire, San Diego, all of those markets would fit into this category where we expect to see new supply increasing actually over the next couple of years. But this is not just a California phenomenon. Florida markets like Miami, Fort Lauderdale, which has of course already been very active, and Tallahassee, also expected to see new supply increase in the near term. And then also New York City and the state of Hawaii, just for some other areas as examples there. So again, there's going to be higher variance moving forward in how new supply is affecting markets. The last couple of years, it's been, you could basically throw a dart at a map and new supply is playing a prominent role in whatever market that dart hits. Moving forward, that's not going to be as much the case. And then with that, some upcoming events that might be relevant for you. I will be speaking October 29th at the Appfolio conference in San Diego. I'll be doing a session about regional trends, along with a fantastic speaker from Zillow. So that's going to be a great session if you're going to be at that conference. And then also I'll be doing a virtual market outlook session for the Mississippi Apartment Association on November 7th. So if that state is relevant to you, be sure to check that out. Registration details will be on our social media for both of those events. And speaking of social media, look for us on your social media platform of choice, ALN Apartment Data or ALN APT Data. We are on all the platforms putting out great content all the time. And our blog, alndata.com/blog. In addition to the newsletter, we've got written content going up on the blog every month that will be helpful for you. So with that, thank you so much, and I'll see you next month.